All right, recall that a balance sheet indicates the financial position of a business on a particular point in time. Now, the, as mentioned, the balance sheet is not static, it's dynamic, it's constantly changing as the company does business. Okay, so for example, as it conducts transactions, okay, so example, like purchasing equipment, or debtors pay the money they owe, or we make payments to our creditors. Those are all examples of transaction. And we're going to define a transaction as the exchange of things of value. Okay? And we use what's called a transaction analysis sheet to show the effects of various transactions on the balance sheet. So I'm going to show you how a transaction analysis sheet works. All right. So what we're going to start off with is beginning balances in the different accounts the company uses. So let's suppose on July 1st that we buy $500 worth of equipment for cash. So what we're going to do is we're going to put minus 500 for cash on July 1st, and we're going to put plus 500 in the fitness equipment account. So what's going to happen is it's going to look like this. So minus 500 for cash and plus 500 for fitness equipment. Then what we're going to do is we're going to put a line all the way across to show addition and come up with new balances. All right. Now let's assume on July 5th that we buy $55 worth of supplies on account. Okay? On account means we promise to pay later. So bought $55 worth of supplies on account. So supplies is going to go up 55 and accounts payable is going to go up 55 as well, because now I owe $55 more. Okay, so I started owing at $4,000. Now I bought equipment on account, I bought supplies on account for 55, so our accounts payable is going up. All right, so we record that transaction and we come up with new balances. Now, let's suppose on July 10th, we receive $3,000 from debtors. So, we receive $3,000 from debtors. So what's going to happen is our cash is going to go up $3,000, and accounts receivable is keeping track of how much people owe us. So if debtors pay us $3,000, they owe us less money. So what's going to happen is accounts receivable is going to go down $3,000. So cash goes up and accounts receivable goes down, and we come up with new balances again. All right, next one. On July 15th, let's assume that we return $400 worth of fitness equipment. So for a cash refund. So cash is going to go up 400 and our fitness equipment is going to go down 400. And then new totals. On July 18th, let's suppose we pay $375 to creditors. So we pay $375 to creditors. So cash is going to go down $375, and then accounts payable is also going to go down because now I don't owe that money. So it's going down. All right, next one. let's assume that the owner on July 21st, the owner gives the business $800 cash. So cash is going to go up 800, and then owner's equity is also going to go up 800, because remember the business entity principle. So whenever the owner gives the business anything, the value of the business is going to go up. And the last one, July 25th, we buy $3,000 worth of equipment. We pay $2,000 cash and put the rest on account. So in this case, okay, equipment's going to go up 3,000, cash is going to go down 1,000, and accounts payable is going to go up 1,000, because now I owe 1,000 more. All right, so in this case, remember, we bought $3,000 worth of equipment, we paid $2,000 cash, and we put the rest on account. Okay, and then we come up with final totals. Now, notice that at the beginning of the month, July 1st, we had $6,000 of cash. At the end of the month, we have $7,325. So this should still equal, your total assets should equal your liabilities plus your owner's equity. If it does not, you've made a mistake in here somewhere, and you're going to have to fix it. Now, a transaction, going back, can affect will always affect at least two accounts. It could affect 3, it could affect 4, but it cannot only affect one account. Okay, so that's how we use our transaction analysis sheet. Okay,